Welcome to Financial Insights in Minutes, where we summarize the day's top financial news videos to save you time. Today, we're diving into potential market upheavals and recession fears, especially in light of the latest trends from financial experts.
We'll explore strong predictions for a market crash and how companies like Geo Financial Services fit into this evolving landscape.
Don't miss what insights could impact your investments. Which videos will we cover today?
Let's get started with our first video.
First, Harry Dent warns of a 94% crash ahead in stock markets, urging caution for investors. Next, Game of Trades highlights the early signs of a recession, urging adjustments to portfolios. Eurodollar University's Jeff Snyder reveals how a U.S. recession affects global risks. Kitco News' Daniel Lacalle discusses the Fed's struggle with inflation and its implications. Figuring Out Money connects 2023's volatility to the painful days of 2007 and 2008. Oxbow Advisors reviews the staggering government spending and its impact on market health. Public App features Hims & Hers CEO discussing growth plans amid medical trends. Lastly, David Lin analyzes why Warren Buffett's Apple stake cut could signal deeper market fears. Welcome to the channel. Today's explosive topic: are markets set for a massive downturn? Joining us is the ever-insightful Harry Dent, founder of HS Dent, who is never afraid to call it as he sees it.
Indeed. Harry has been a prominent economic forecaster for decades, and he doesn't hold back his opinions. Let's navigate through the turbulent waters of today's economic predictions together.
What's the primary message from Harry Dent's interview? What does he foresee?
Harry posits that we are headed toward a harsh economic crash, predicting declines of 94% for the Nasdaq and 88% for the S&P 500, reminiscent of the 2008 financial crisis, but even more severe.
Let's dig into those key points. What's happening with these bubbles?
Harry emphasizes that the recent economic growth is artificially inflated, with $27 trillion in stimulus distorting real market conditions. It's like trying to stay afloat on a raft with a slow leak.
What about Harry's crash predictions? How bad does it get?
He predicts a significant market correction, down to 94% for the Nasdaq. That means possible levels around 10,088 or even back to 6,700. Talk about dramatic downturns.
Let's touch on inflation. What's the scoop there?
Harry argues that upcoming demographic trends spell deflation, not inflation, leading to a long-term period of low inflation rates. It's a mixed bag of sweet and sour.
And what about government roles in all of this?
Harry critiques the government's approach, saying they've created a monster by trying to manipulate the economy instead of letting it correct itself. It's like treating a fever with ice cream, not medicine.
Time for some crystal ball gazing. What does Harry foresee for the future?
Harry believes we're looking at a crash worse than both the early 2000s and 2008, drawing painful parallels to the Great Depression. It's a scary history lesson.
Harry's investment strategies sound intriguing. What does he recommend?
He advocates for treasury bonds as a safety net during the coming storm. When stocks plunge, bonds could soar in value, proof that not all that glitters is gold.
As we wrap up, what should viewers take away from this?
Harry calls for an undeniable shift in approach, one that respects economic cycles instead of trying to outsmart them with artificial means. Prepare for stormy seas, everyone.
Welcome to Game of Trades. Today's voyage is all about the storm brewing on the economic horizon. The 2024 recession seems to have set sail, and it's time to figure out how to navigate these turbulent waters.
That's right. The discussion sheds light on various economic indicators, like the rising unemployment rate and what it means for the stock market. Buckle your life jackets. It's going to be a bumpy ride.
So what's the main thesis driving today's discussion?
The core thesis posits that the U.S. economy is gearing up for a recession. This claim is backed by a rising unemployment rate, which has increased by 50 basis points recently, signaling economic contraction.
Let's unpack those key points. What's happening with unemployment?
The unemployment rate increased by 50 basis points over the past 6 months, now sitting at 4.3%. Historically, such increases have preceded economic recessions.
And how about the PMI survey?
The ISM PMI survey highlights that we're below 50, meaning the economy is contracting. recent readings are painting a grim picture of economic activity.
What can you tell us about the yield curve situation?
This yield curve inversion is the longest we've seen since 1929, heightening the recession odds as it indicates a tightening of monetary policy.
Let's dive into investment strategies. What positions are being favored?
Currently, there is a heavy allocation towards TLT and ETF tracking U.S. Treasury bonds, historically known to rise during economic downturns, making it a solid bet.
What predictions are being made moving forward?
The forecast suggests ongoing economic struggles, especially as we see more investors rushing to safe assets like Treasury bonds as stock prices tumble.
And what about market volatility?
The VIX has hit levels comparable to past financial crises, indicating that fear is palpable in the markets. However, these spikes have historically signaled potential buying opportunities.
So to wrap it up, what are the big takeaways?
The key is to be alert to recession signals. Rising unemployment and contracting PMI are crucial indicators. Adjusting investment strategies accordingly could mitigate risks during this volatile time.
Welcome to Eurodollar University. Today, we navigate the currents of global risk assets and discuss what a U.S. recession means for the world economy. Joining us is economic expert Jeff Snyder, who's on deck to share his insights.
Absolutely. Jeff sheds light on the recent risks across markets and how the landscape has shifted dramatically, especially after those recent shifts in data. Hold on to your hats, folks.
So what's the main thesis here from Jeff Snyder?
The core thesis is straightforward. A U.S. recession not only alters the risks associated with investments, but also signals that the process of repricing risk has just commenced. The global financial system is now more precarious than we were led to believe.
What about the immediate market reactions? What's the scoop?
On turnaround Tuesday, we saw stocks rise and interest rates ease after a significant market crash. However, this does not negate the systemic risk looming over the markets.
And what's the deal with Japanese banks? Why are they pivotal?
Japanese banks have been a major player in providing credit globally, but are now exposed due to the unfolding recession narrative, leading them to pull back and initiate liquidations.
Interesting. What predictions did Jeff detail?
Among his predictions, he noted a surge of economists calling for emergency rate cuts. This indicates a shift from a strong economic narrative to one concerned with recession looming large.
What does Jeff see for the foreseeable future?
He predicts ongoing risk repricing and increased market volatility as more investors become aware of the risks lurking beneath the surface.
So what are the final takeaways from Jeff Snyder's insights?
The overall message is clear. As we confront this shift, there's an urgent need for caution. The systemic risk landscape is changing, and the markets are waking up to it. Better buckle up.
Welcome to Kitco News. Today we're diving deep into the Fed's current economic dilemmas and challenges, featuring renowned economist Daniel Lacalle.
Exactly. Daniel's impressive credentials and extensive experience in economic analysis make him the perfect guide through today's turbulent waters.
So what's the crux of Daniel's talk?
At the heart of this discussion is the Fed's struggle between confronting inflation and maintaining economic stability, especially after significant sell-offs in the markets.
Let's break down the key points, starting with market volatility.
Investors witnessed a staggering sell-off of $6.5 trillion. But now the S&P 500 is showing signs of recovery, though that may just be the calm before the storm.
What's up with the Fed's recent decision on interest rates?
Despite concerning economic indicators, the Fed chose to keep rates steady, drawing critiques for relying heavily on backward-looking data rather than forward indicators.
And what about the national debt?
The national debt now exceeds $35 trillion, with a GDP ratio of 122%, which raises flags on sustainability.
Let's pivot to global concerns, particularly China.
China's real estate bubble might not just affect them locally. It's a significant global concern, as their economic challenges ripple across trade dynamics.
Gold has been a hot topic too, right? What's Daniel's take?
Indeed, gold serves as a stable asset amid market instability. A solid recommendation is a 20% allocation in any investment portfolio for balance.
What about predictions moving forward?
Daniel predicts continued liquidity from central banks could eventually restore bullish market conditions, even as economic data remains shaky.
Wrapping things up, what are the main takeaways?
Moving forward, we'll need to navigate these turbulent economic waters carefully. The Fed must strike a delicate balance or risk larger ramifications.
Any closing thoughts on investment strategies?
Investors should consider adjusting their portfolios strategically, focusing on stability amidst the chaos we're experiencing.
Welcome back to Figuring Out Money. Today's topic is wild market volatility. How does it compare to the turbulent days of 2007 and 2008? Buckle up for some insights.
Absolutely. Michael dives into the uncanny resemblance between today's volatility and the past spikes we saw during the financial crisis. You won't want to miss this analysis.
So what's the core thesis from Michael's discussion? What's the main navigational point here?
The central thesis is clear. The current market volatility bears striking similarity to 2007's volatility regime, raising flags for potential market shifts. Traders and investors alike should tread carefully.
What about those market expectations we heard about?
Michael highlights that there was a 68% chance the market would close within expected moves. Spot on with today's movement right to the penny.
Interesting. And what about the VIX?
The analysis of the VIX shows a tightening pattern in Bollinger Bands, signaling potential volatility spikes reminiscent of 2007. Alarming yet fascinating.
And what strategies should investors consider?
Investors are advised to remain cautious, manage exposure wisely, and lower positions when volatility peaks. It's about navigating these turbulent waters carefully.
What predictions did Michael share with us?
He predicts increased volatility and turbulent swings, echoing the patterns from 2007. Mega-cap stocks might be in for some bumpy rides.
And what about interest rates?
There's a potential for federal rate cuts, which could significantly impact market dynamics. Investors must stay alert for these changes.
Wrapping up, what are the key takeaways here?
Investors must exercise caution, managing risk as current volatility mirrors that of 2007. Based on history, proactive strategies are essential.
So what final insights can we glean?
It's crucial to recognize volatility trends clearly and adjust investment strategies accordingly. After all, navigating the currents of market change is key.
Welcome to Oxbow Advisors. Are you ready to navigate through today's turbulent economic waters? We're diving deep with the insightful Larry McDonald, a renowned author and analyst. Buckle up because we're in for a wild ride.
Larry's extensive experience and talent for precisely interpreting market signals make him a reputable source for understanding the current economic landscape. Let's get straight to the facts.
So what's the central thesis that Larry presents?
Larry argues that the staggering increase in government spending post-pandemic could unleash volatility in the markets. He emphasizes the need for investors to pay attention to these economic signals.
What crucial insights does Larry discuss regarding COVID-19's economic impact?
Larry highlights the $16 trillion in fiscal response, surprising given that the prior decade had just $4 trillion. This has created misplaced expectations among investors.
Let's talk about the great migration of capital. What's going on here?
Larry reveals a striking fact. The Nasdaq was worth $24 trillion, while the energy sector sits at only $3 trillion. This significant gap shows how investor behavior has shifted.
And how does the energy sector play into all this?
Larry argues that despite the push for green energy, fossil fuels remain vital, especially as economies like India strive for energy access. The demand for oil and gas is far from fading.
Interesting take. What does Larry say about passive investing?
He warns that as passive investing grows, a lack of due diligence could lead to market distortions. Too many investors now rely on automated approaches rather than fundamental analysis.
What about bubbles in the market?
Larry predicts that recent market volatility could signal the popping of certain bubbles, which presents both risks and potential opportunities for savvy investors.
What predictions does Larry have for the economy in the coming year?
He foresees a weaker dollar, as the Fed will likely face pressure to cut rates, leading to persistent inflation that's higher than most expect.
And what about commodities?
Larry believes commodities will gain traction as the market grapples with inflation and supply chain disruptions. Investment in copper and other hard assets is strategic.
So, what's the overall takeaway from Larry's discussion?
The crux of it is that we're in for significant market shifts. Investors must diversify and pay attention to the economic signals. It's not just about riding the waves, it's about reading the currents.
And what's Larry's last bit of advice for investors?
He emphasizes the importance of strategic investing in this tumultuous environment. Positioning oriented assets wisely can help weather the looming economic storms.
Welcome to Public's Leading Indicator Show. Today, we're diving into the trending world of telehealth with none other than Andrew Dam, co-founder and CEO of Hims & Hers. Buckle up.
Absolutely. Andrew is well-versed in the evolving landscape of digital health, especially concerning women's health and obesity treatments. This should be enlightening.
So, what's the crux of today's discussion?
The key takeaway here is that Hims & Hers sees a significant opportunity in women's health and personalized treatments set to outpace its men's business. It's about offering tailored care that meets real consumer needs.
Let's break down some key insights from Andrew. First, what's happening with subscriber growth?
Hims & Hers has seen astounding growth, nearing 2 million subscribers and setting an ambitious goal of reaching tens of millions within the next 5 to 7 years.
And how about their financial performance?
Incredible! The revenue jumped 52% year over year, hitting $316 million. This growth is driven by their expanding product offerings.
Personalization seems to be a recurring theme. What's happening here?
Definitely. They're tailoring their health solutions to meet the unique needs of each demographic. More than 55% of new clients are opting for these personalized offerings.
What's the scoop on market trends that Andrew highlighted?
There's a booming demand for obesity treatments. However, they also acknowledge challenges around pharmaceutical supply, which could impact growth.
Looking ahead, what does the future hold for Hims & Hers?
They're focusing on strategic investments in personalized care, and their expansion plans indicate a keen focus on women's health moving forward.
What predictions did Andrew venture about the company's future?
He anticipates a significant increase in market share, especially within women's health categories. The growth is likely to be robust.
And what about the subscriber growth?
Andrew believes they will attract tens of millions of subscribers as they continue focusing on personalized health solutions. A bold forecast.
Wrapping it all up, what are the final takeaways?
Hims & Hers is truly pioneering personalized care in women's health and is well-positioned for substantial growth. The development of targeted solutions will likely transform how healthcare is accessed and utilized in the market.
Welcome back to the channel. Today we're diving into the intriguing world of investments, particularly why Warren Buffett decided to cut his stake in Apple. With Apple's stock performance under scrutiny, it's time to navigate through these waters.
Exactly. Our guest, Singh, founder of Special Situations Research and a former portfolio manager at Goldman Sachs, will help us understand the market's shifting tides. Buckle up, this is going to be eye-opening.
So what should viewers take away from Buffett's bold move?
Buffett's reduction of his stake signals significant concerns about future stock performance and market volatility, a situation not unfamiliar in recent times.
Let's break down the key points from Jay's analysis. What can you share about market volatility?
The Nasdaq has been on a rocky path, dropping close to 10% since its peak mid-July, and last week's decline marked the biggest drop since May of 2024. Buckle in, folks.
And how does Buffett's cash stash relate to our conversation?
Berkshire Hathaway now boasts a record cash reserve of $277 billion, suggesting that Buffett is readying for potential market downturns.
What about consumer behavior trends?
Consumer spending is showing cracks, with retail sales struggling. Pandemic savings are down to negative $72 billion. Yikes!
Global factors must be considered as well. What do we see here?
Economic indicators from Europe and China are dragging down market sentiment, compelling the Bank of Canada and the Bank of England to implement rate cuts.
What's on the forecast horizon for the market?
With economic growth signals trending low, predictions of a potential recession loom large, keeping market volatility in play.
Are there any alarming signals specifically pertaining to company valuations?
Absolutely. Just a modest decline in revenue growth expectations could trigger dangers for stock prices across the board.
To wrap it all up, what should viewers keep in mind?
Investors need to exercise caution amid the economic signals suggesting increased volatility. It's not just about cutting stakes, it's a call to reassess investments.
And what about Buffett's strategic approach?
Buffett's actions demonstrate the importance of strategic financial planning. Navigating through uncertain economic waters is crucial.
In review, Harry Dent's call for an up to 94% crash starkly contrasts with Game of Trade's more measured take on recession signals.
As discussions go round, Daniel Lacalle emphasizes the Fed's current dilemma, while others propose strategic portfolio adjustments.
Expert opinions agree on the importance of vigilance, but differ on tangible strategies for approaching the next volatile phase ahead. Thanks for watching Financial Insights in Minutes for August 7th, 2024. If you'd like more time-saving content, please remember to like and subscribe. If you have ideas for more channels you'd like to see summarized, drop a comment below. See you next time.